Hey, welcome to the show. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. We've got two important things to talk about. The first one I think that we should talk about is dividend investing. In particular, there are two ETFs, exchange traded funds, if you don't know what that means, ETF. There are two from Vanguard that are very, very popular for investors, or a popular investment option for those seeking income and for those seeking dividend exposure from common stocks and who want to be invested. One is doing okay this year and one is not. What's the difference? And why would there be a difference? Like, aren't all dividend stocks the same? And I've said this before, treating dividend stocks like they're a separate asset class apart from regular stocks that don't pay dividends doesn't make much sense to me. They're still stocks, they're still risky. And the fact that they have a dividend, I think, attracts a lot of people. In particular, baby boomers have been binging like crazy on dividend paying stocks, especially when interest rates were at or near zero. And I think they're paying a very steep price now with severe capital losses. So we're going to take a look at those two ETFs and talk a bit about dividend investing. And I think you're going to learn something new. And the other thing we're going to talk about is Ozempic. With Ozempic, there's Mounjaro, and there's a couple of these GLP drugs. These are the new class of weight loss drugs. They make you feel full, and have friends who are on these drugs and have been on them, and they all tell me the same thing. They actually have to force themselves to eat because you're just not hungry. And imagine if you can just not be hungry. That's the toughest part about losing weight, is always being hungry and tempted. So these could be miracle drugs. They represent a whole new class of drugs, and the potential of what these drugs could do could be bigger and better than anything we've ever seen from the healthcare industry. So let's roll a quick intro. We're going to talk about these two things. While you're watching, if you have any questions, please hit me up in the comments. I love hearing from you. If you don't mind giving me a thumbs up or a wow or a heart reaction, depending on which social media platform you're watching on, I'd appreciate it. It helps spread the good word about the educational work that we're doing here, and it'll help your other contacts see what we're talking about. Here's the intro, and we're going to get into this now. Welcome to the show. Thank you so much for joining us. We're just getting started, making sure I have all my screens ready to show you. I'm Mitch Goldberg, and if you have any questions, hit me up in the comments. If you want to reach out to me and have a direct one-on-one conversation about your investing, about your financial plan, what you should be doing now in anticipation of the next life cycle that you're going to be going through and the life cycles after that, you should reach out to me. I can be reached at clientfirststrategy.com. My number is running along the ticker at the bottom here, but if you're just listening and not watching, 631-920-6624, 631-920-6624. Again, check me out, Client for Strategies. Just send me a DM. We'll set up a time for you and I to talk one-on-one and see if you are on your way with your investments and how long they could last in retirement and what you could be doing now that's different than maybe what you've done in the past that could help you possibly improve your odds of, not running out of money in retirement. All right, so a couple of things to talk about. I'm going to just do a quick update. So the Dow, after being up over 300 points yesterday, was up another 13 today. All day long, the markets were vacillating between slight gains and slight losses. It was basically a very flat, very boring day. We had some earnings. We had some stocks up a nice amount, some down a nice amount, but overall, it bounced back between the buys and sells. Pretty boring even day. Nasdaq was off 0.25% after being up 1.6% yesterday. S&P 500 was down a little. It wasn't down 43 points. Okay. It was down 0.43, so less than a half a point, down 0.1%. It's about the smallest down move I think I've ever seen in a major average. By the way, you can't invest directly into an index, but you can invest in a security that tracks or mimics an index. Gold was barely up, hanging out there in the 1900s, but hasn't really made any gigantic move given we had the geopolitical events that are ongoing between Israel and Hamas, and we'll see if that spreads to the greater region. Oil up $1, but it's been trending down lately, so it's back up to 87. Tough to make up its mind. Is the economy slowing down globally? Is the United States going into a hard landing, aka recession? Oil should be a lot lower. If not, then oil's probably justifiably where it should be. Maybe even it should be a little bit higher. Yields surged a little bit more today. The 10-year yield, 4.8%, almost back to the high it reached about a week ago. That's a big deal if you see that, the 10-year yield. Okay. Let's get down here. All right. That's better. Okay. The 10-year yield, okay, 4.83%. The VIX, 17.88, up a little bit, but that's been trading around 17, 18 for a while. It does not, to me, indicate that there's a lot of nervousness in the market. As a matter of fact, I was looking at spreads. Now, when we talk about spreads, you should know that when we talk about spreads, we're talking an overall rate of corporate bonds, investment-grade corporate bonds compared to Treasury securities. Corporate bonds are usually a higher yield than Treasuries because Treasuries are considered a safer bet. They're guaranteed to mature, guaranteed for principal and interest, right? So they should have a lower yield than corporate bonds. But looking at USIG, which is a big ETF for my shares that tracks corporate bonds that mature in a year or more, the yield on that ETF is only 4%, which is a lot lower than Treasury yields. So if there was worry, let me say this, if there's worry about an imminent recession, that ETF should be paying out a lot more than 4%. It should be over 5.5%, maybe even over 6%. So that to me tells us that, the smart money, the bond market, is not telling us that a recession is on the way. I know people like to talk about that and say how bad the economy is. Now, I realize that for some of you, the economy might not be that good because it's not the same for everybody. But generally, the stats of low unemployment, low or negative spreads, it's telling you that the economy is not so bad and probably a recession is not imminent. Not to say it can't happen, but definitely I don't think this is a near-term event. If it does near-term, I'm talking 3 to 6 months. Okay. I don't think it happens that time frame. We do go through recessions, and that's a fact of life. So I'm not going to say, oh, we're never going to have a recession again. We are. It's just a matter of knowing when. And I just find it so odd that so many people come out and say they know when we're going to have a recession. We're going to have a recession in the second half of 2024. People are saying we're going to have a recession in the second half of 2023, then in the fourth quarter of 2023, which we're in now. And people don't really know. This is why I always say you have to have a portfolio that you could stick with good times and bad times, because recessions are not separate from economic expansions. Okay. They're part of economic expansions. Bull markets and bear markets are not separate. They're part of the same long-term trend of cycles of ups and downs. But over the long term, the cycles do cycle higher. The highs go higher, the lows are higher, and that's where we over time get a short-term volatile chart like this. But I'm waving my hand up and down quickly. If you're just listening, not watching, but over time it travels upward from the lower left to the upper right. Let's take a look at some dividend ETFs. Okay. I've chosen two very popular ones, and this is the Vanguard High Dividend Yield Index Fund ETF. And I'm comparing it to the Vanguard Dividend Appreciation Index Fund. Now, they both have the same names, Vanguard and Dividend. By the way, lots of fund companies from Fidelity to Schwab. Every fund company has dividend ETFs. I'm just using Vanguard to pick on them because I use a lot of Vanguard products in my own my clients' portfolios, and B, because these two are probably the most popular dividend fund offerings there are. All right, so let's take a look. The high dividend yield. Let me just scroll down here. Has a dividend yield of 3.2%, and the dividend appreciation fund has a dividend yield of only 2%. Now, 3%, 2%, they're still pretty low. But there is a difference between 3.2 and 2, and that is, a really over a 50% difference. So which one is better? They both have the same expense ratio. Okay. They both are offered by the same sponsor. And yet, the one with the fatter dividend that might attract more investors, in particular the boomers who in the last couple of years are struggling to find income because we're getting nothing in the bank. Well, this one is down almost 4% year to date, and it's up less than 5% in the last year, versus the dividend appreciation fund with the smaller dividend is up almost 4% year to date, but it's up over 13%. So, 2.5 times as much in the last year. So were you doing yourself a service by buying the one with the fatter dividend yield? And I get it. What a lot of investors are trying to do when they retire is they want to convert their investments into income-producing investments that throw off enough income for them to live on so they never have to touch the principal. And I hear that a lot. A lot of people saying, oh, investor, you never touch the principal. But the principal could be at risk too. And I think there's a misconception that a higher dividend yield portfolio is going to be a safer portfolio. But let's compare the two. The expense ratio is the same. The performance is very, very different, though. These are pretty significant differences. So I'm going to just blow this one up so we can get a better view of this one, okay? And look at the top holdings. 3% of a little over 3% of the fund is in ExxonMobil. Oil's been doing pretty good this year. JP Morgan, Johnson & Johnson, Broadcom, Procter, Home Depot, Chevron, Merck, AbbVie, and Pepsi. So I think by any stretch you could call all of these companies blue chips. And I think you could call them, names that you've heard of. But they haven't done particularly great this year. Just to give you an indication, let's say hypothetically, we take a look at. I just want to look at Home Depot, how Home Depot did this year, how it's doing year to date. Just take a look. Okay, so Home Depot is down over 6% on the year. So that's the problem when you have big stocks like the consumer staples that are in this fund. Some of them are consumer staples. They're off a lot. And then if we take a look and look at consumer staples as a group, I have to make this a little smaller so I could get to my watch list. And you're welcome to copy my watch list. If you want to know what's in my watch list, send me a DM and I'll share it with you. Let's take a look at consumer staples. I'm going to make this bigger so you could get a good view of what I'm looking at. If you look at this line on the side, okay, the left is the 52-week low, the right is the 52-week high. Look how much red, look how down from the 52-week highs these supposedly more conservative, stable consumer staples stocks are. Because these companies, they make what you need, like food, toilet paper, not things that you necessarily want, which would be consumer discretion. But B&G Foods, Hain Celestial, even Mondelez has come way down from its high. Constellation Brands, or they're a liquor there. I wouldn't call them necessarily staples, but Coke is way down from its high. CVS way down from its high. Kellogg's way down from its high. Costco is hanging up there, not far from a high, but they do a lot more than just consumer staples. Walgreens way down from its high. Church and Dwight hanging in there okay. Procter and Gamble hanging in there okay. Walmart doing well, but Kimberly Clark way down from its high. Colgate Palmolive way down from its high. Kraft Heinz way down from its high. That used to pay a big dividend. Investors like, oh, that's a good one. It pays a big dividend. It's Kraft Heinz. I've heard of the name, and look how badly they've done. I'm not saying dividend stocks are bad. I'm just saying that buying a stock solely based on the dividend and the fact that you think it's a familiar name to you, that's not good enough of a reason to buy a stock, in my opinion. General Mills way down from its high, Pepsi way down from its high, Hershey, Clorox, Beyond Meat, all way down from their highs. That's consumer staples, okay? Now let's take a look at the other ETF. This is the Vanguard Dividend Appreciation Fund. The symbol is VIG, V-I-G, and we call it the VIG. All right, just our little pet name. But if you take a look what's in this fund, why is this fund doing so much better than the other one, both on a year-to-date and in the last year? Well, look what it's got. Microsoft, Apple, Exxon. They both have Exxon. See, why would Exxon be in the dividend appreciation portfolio, and Broadcom and Johnson & Johnson? They're in both portfolios. Nevertheless, you have different stocks that are doing differently. And in this fund, 20% of the portfolio is in technology. What's been doing the best this year? Large cap technology stocks. But it's got a slightly different makeup of top performers. And it's in a different, some of the stocks are different. In particular, Microsoft being the biggest fund. Microsoft being the largest holding in the portfolio. And just to give you an example, let's see where Microsoft is on the year. Microsoft is up 38% year to date. So it makes sense that if the holdings of a fund are doing better in one fund than the other, then it's easy to choose which fund should be doing better, right? That explains it. That's what I want to talk about there. The other thing I want to talk about is Ozempic. Let me just go back to that while you're looking at a screen that was just blank a second ago. I'm going to go to my watch list. And this is important because Ozempic, the weight loss drugs, the GLPs, which is a hormone that makes your body think it's full, is just an entirely new class of drugs. It's expected to be maybe a $100 billion industry in and of itself from one class of drugs, possibly over the next 5 to 10 years, which, if you think about it, is very, very, very quick. And aptly named for the sector, I call it The Biggest Loser. See The Biggest Losers? Remember the TV show The Biggest Losers about weight loss? So my contention with this is to say, pop myself up at the screen here. My contention with the weight loss drugs, the GLP drugs, they're from companies called Novo Nordisk, which is a Danish company. It's now the biggest company in Europe because of its weight loss drugs. And then there's Eli Lilly, the United States company, which now has one of these GLP drugs in the market, and it is awaiting approval for this drug to be used for specifically weight loss. So Novo Nordisk has two drugs, but they're actually the same drug for different indications, for different approvals, one for diabetes, one for weight loss, whereas Eli Lilly's is only approved for diabetes, but they expect by the end of 2023 for theirs to be approved for weight loss as well. And let's take a look. So these are having an impact on the economy. And think about it in terms of if airline passengers are 10% lighter on average, the airline saves a fortune every year on fuel. Now, if you've been on an airplane recently, you know what it's like getting stuck sitting next to somebody who is overweight. And we've all been there. Okay. So I'm not talking about a normal person like you and I. They're just, we know what it's like to sit in a small airplane seat next to other people. Maybe that was too much for the live stream, but too late. I said it and I can't edit it out. Okay. Then you have companies like Walmart, which came out and said they see an impact on junk food, snack sales because of the weight loss drugs. And then I take a look at the stocks and I say, well, you know what? Americans could have billions and billions of less calories consumed every year. So you have to look at what it's impacting. A couple of things that'll impact. One of the biggest causes of premature death is obesity. It has to do with diabetes. It has to do with sleep apnea. These drugs are indicated for diabetes and weight loss, but they're being studied because they're showing results in studies for sleep apnea, for lowering the risk of heart disease and stroke. And they're even being studied that they could help people with addiction, overcoming addiction. And now they could possibly work for people who suffer from kidney disease. So the indications for these drugs is pretty incredible. And it just goes to show you how many health problems could come about from being overweight. So let's take a look at the stocks that I'm talking to you about. Wait. All right, here we go. ResMed makes a machine for sleep apnea from 243 to 141. Look at that, the line I'm showing you, almost to the year low, way off its year high. Look at Pod, which is basically works with an insulin pump. You wear it on your person, pumps insulin every few hours from 335 to 141. Stock got killed. Zimmer Biomet, they make artificial, hips and joints and knees, things like that. Way, way down from its 52-week high. And then take a look at McDonald's, even though these stocks are up today, but take a look at McDonald's. Blue chip name, $2.99 to $2.50. So lost a pretty big chunk of value. And a lot of that worry is ascribed to weight loss drugs and people just not eating out as much, not getting the munchies as much. I mean, nobody goes to McDonald's, Wendy's, or Burger King and says, I'm eating this food because I really want to all the time. It's munchies food. It's cheap food. It's fast food, not healthy food. And that's what people go for. But because of the weight loss drugs, people aren't tempted to go to these anymore. In fact, people don't even want it anymore. And then you take a look at Hershey, way down 276 to 190. And then you take a look at the two winners that created this class of drugs, Eli Lilly, which that's all green, and Novo Nordisk, and that line is all green. So these stocks are trading right up to their 52-week highs. They've been enormous winners over the years, the last 2 years, especially because of these particular drugs. So the talk is, how are these drugs affecting the economy? And I think the effect on the economy, my opinion, could be tremendous. And I think they could affect every facet of life. The only problem we're going to have is with people living longer because they're losing weight. What are we going to do with all these old people if they have cognitive issues? So lots of things to consider, but these drugs really are big enough and important enough to change the entire economy and the stock market. We'll see how it plays out. Thanks for watching. I'm going to get going, and I'll see you tomorrow.